Yeah, May ended up being quite a busy and volatile month, to be honest. Normally we get a small reporting season, but this time around, on top of the corporate results that were scheduled, there were lots of these confessions from companies that had to come out and tell us that things weren't actually going as well as they thought. On top of that, you had the Reserve Bank announcement earlier in the month, and then to bookend the month, you had the budget announcement. So there was plenty for the market to digest. I think overall, a pretty good month. We certainly, towards the end of the month, had a bit of a kickstart with the electricity sector coming out with a really positive announcement. I'll talk about that a little bit later. But overall, I think probably a B minus for how May panned out for our market. Yeah, bit of a pick and mix in terms of results for May. There were some great ones and some real shockers. So at I guess, the disappointing end of town, Tourism Holdings and Michael Hill Jeweller came out with some updates that didn't meet market expectations, and the share prices fell pretty heavily. Fletcher Buildings was at that end of town as well. At the more positive end, some of our small caps, so Gentrack, ERO did reasonably well, some great updates there, and both of them were rewarded with share prices up sort of 10-20% there. Napier Port, that was a nice one to see, where things are getting back on track after the Cyclone Gabriel impacts that they had last year. So share price up there a little bit as well. And then we obviously had some big powerhouse names like Fisher and Paykel Healthcare and Main Freight report as well. Fisher and Paykel, good result. It was kind of pre-guided, but more importantly, some of their new products that they're bringing to market are showing good demand and good sales growth. So that was taken well by the market, and the outlook for next year looks pretty strong for them to get back to more normal levels in terms of their margins, which have been under a little bit of pressure because of COVID impacts around the cost of shipping and materials and those sorts of things. And then Main Freight, it's one we really keep an eye on as a proxy for what's going on around the economy. They've got operations all over the world. Profit fell over 30%, which seems like, that's not a great outcome, but it was largely expected because they've had this windfall through COVID where shipping delays and the cost of shipping has gone up, and that's benefited Main Freight to some degree. They've also been winning market share, which is important. So overall, look, I think the market saw it as a reasonable result in what is a tough operating background. They don't ever give explicit guidance for the year forward this early in the year, but we think they're on track, and some of the commentary was a little more positive than the market probably expected. So some good results from those bigger names on our market. Look, it's one of those budgets where, not a lot of surprises, which is probably a good one. If you were hoping for lots of free money, then a little bit disappointing. But for financial markets and the market in general, I think no surprises is probably a good one. The coalition delivered on some of the tax cuts they had promised. That was probably the showpiece of the overall announcements, and a big part of that was shifting tax brackets. That's something that hasn't been done in New Zealand since 2010. So, it's been a long time coming that, we have that progressive tax rate that comes through, but the brackets before you tip over to, I guess, the next tax rate have all been shifted up, which is probably a fairer outcome, and something, like I said, was a long time coming. Interestingly for me, I think Treasury, their announcement or their sort of forecasts for inflation seem to be coming down faster than what the Reserve Bank has. Unemployment they see is rising faster than the Reserve Bank has got at the moment, and they see the official cash rate falling before the end of the year. And remember, that's quite different to the Reserve Bank, who doesn't have an OCR cut forecast until sometime in the middle of next year. So Treasury coming out with some numbers that are probably a little bit more aligned in terms of that OCR track to what financial markets are expecting. I guess the key focus for the market in that update was also around, would the budget overall be inflationary? Because that could spook the Reserve Bank and keep rates higher for even longer. But I think overall, the Reserve Bank will be satisfied that there's nothing in that budget to be too overly inflationary, above and beyond, business as usual. So that's positive from that perspective as well, and should sort of allay some of those fears that the Reserve Bank could potentially lift interest rates even from these levels. I think that interest rates will likely stay put, but fascinating to see the difference between the Reserve Bank forecasts and what Treasury has come out in their forecasts. Yeah, so in terms of financial markets and those of us that live and breathe it, this is kind of as exciting as it gets. So there was a lot of uncertainty around Tiwai Point, which is the aluminium smelter located in the South Island, the lower south, whether they would stay or go. The current contract that they had with our electricity sector lasted till the end of 2024. So we were getting pretty close to crunch time. And last week we got the announcement that Rio Tinto, which is the owner of the Tiwai aluminium smelter, has decided to stay on for another 20 years. Now they've got individual contracts and there's a bit of detail in there, but essentially Meridian Energy is the one that the largest portion of that contract is with. So that's out for the next 20 years, which gets us through to 2044. There is an option to cancel that a decade in, but regardless, having 10 years of future sort of certainty is really important for our overall sector. And more importantly for you and I, there are some what's called demand response options in there, where if we're not generating enough electricity because lake levels are low and we're not getting as much water through our hydro dams, then there is part of that contract that requires Rio to kind of pare back its electricity usage to make sure the rest of us can keep our lights on. So lots to go through in that detail, but I think overall a good outcome for the sector because it provides some demand certainty from the biggest consumer in New Zealand. It allows them to develop new renewable electricity sources, knowing that demand's not going to disappear, at the drop of a hat. It's around for the next decade at least, and they can plan a long way ahead. And for you and I, it means the lights will stay on when things get a little bit tight because Rio Tinto, through its Tiwai aluminium smelter, will pull back some of the demand to make sure the balance of supply and demand in that electricity sector stays as it's needed. So a great outcome for the sector, and I think a very good outcome for New Zealand as a whole as we move to more of a renewable base from the great starting point that we've got already.
For more insights, visit craigsip.com.